Welcome to the Weekly Notebook Review. I am Robert McGroarty. This podcast takes on a bit of a different format where we are live each week on Twitter Spaces. I crack open my notebook and review Hedgeye research with anyone who wants to learn a better way to invest. We feature both Hedgeye power users as well as some special guests that might pop in. If you want to learn more about our research, visit hedgeye.com. If you'd like to participate in the live stream, follow me on Twitter at HedgeyeRJM. Now, let's review the data.
Good evening. It is June 27th. This is the late show, Weekly Notebook Review. We'll let some folks kind of come in and get things rocking and rolling. If you're jumping in, you want to come up and be a speaker, by all means. The Weekly Notebook Review, as many of you know, is really for Hedgeye Nation, founded by Hedgeye Nation for Hedgeye Nation. It's to review the signals on the page, the notebook from our weekend work. This week I had to bring it forward a little bit, so we're doing it on a Tuesday night rather than a Wednesday, but still lots to discuss. We got Powell in the morning, and a lot of other components to kind of review. So why don't we just dive right in, I guess. All right, so June 27th, it's about 8:30 here on the East Coast. Again, this is the late show. We had some requests recently, one in particular from Pokey, the Juice Box, saying that the 4:30 sessions were a little tricky. So again, giving the people what they're asking for. We're going to be off next week. I'm taking a little bit of holiday. I'm going to go play some golf out in Wisconsin with some good friends, celebrate my best mate's 40th birthday. So it should be a lot of fun next week. But regardless, that is not what we're here for. We're here to review the notebook, review the signals that we kind of dove into over the weekend. So typically on the Weekly Notebook Review, we review kind of things that we were thinking about coming into the week, and then how those have changed or they're improved, weakened, kind of gone flat midweek, and then going and how we're going to get ourselves set up for the rest of this week, next quarter, next month, et cetera, et cetera. So quarter is finally almost coming to a close here. So we got a few more days left. At the end of this week, we'll close out Q2. Then we'll be off onto Q3 of 23 in the back half of the year. So again, lots to review here. We will dive right into it. I think some of the three components that really are jumping out on my screen as of this evening, after doing some the weekend work on Sunday and the follow through here this week, would be the recent shift in Bitcoin, gold, the dollar, and really the VIX. So I know we've talked about those four components a lot as of late. Last week we certainly we reviewed a bit of the fixed income side of the house, which again I do actually that setup's looking better and better. Although we did get a lot of higher highs and higher lows on the 10-year this morning. So that's down at 3.63 the low end of that risk range to 3.86. So we got about 10 basis points to the upside still. Today, it looks like we're kind of opening up the evening session kind of flat on those bonds, but that setup again, the yield curve is. I feel like there was a point in time a few months ago that it was just felt like I was repeating myself each and every week, just reiterating the recession risk rising, but that's really that's what you're seeing with the yield curve again when you're at minus 0.994. At the moment, so call it round up to minus 100 basis points, and that yield curve is signaling a recession risk is on the horizon. So the longer end of the curve is what is pricing that in. The interesting thing here, though, is you've got the 30-year in a bearish trend, the 10-year neutral, and the 2-year in bullish. So that 2-year note still has room to the upside, and to maintain that trend. The 30-year being bearish and the neutral and the 10-year are quite interesting. But as I just mentioned, both the 30-year and 10-year did put in higher highs and higher lows as of this morning. So again, could we see a signal shift on that 30-year? The main takeaway for me is just stickier for longer. So until we kind of see that 10-year trend pivot to a bearish trend on the yield, I think the higher for longer is the play. TLT or certainly BNDD is how we're expressing that. We added some other bond exposure most recently, last couple of days, in the re-rank product from Keith. But I think BNDD is probably one of the our way of expressing that. Sometimes if you need more liquidity, sort of TLT or EDV could be a good way of doing that as well. But that is at one of the second smallest position sizing in the multifamily office portfolio. So keep that in mind as well, right? So it's not a huge position for Keith, and I think where he's seeing more opportunity and more is just a better better signal, I guess is the word I'm looking for, would be in U.S. equities and in Japanese equities, really. So we added things like healthcare equipment yesterday, I believe it was, and we added ITA back to the portfolio most recently as well. So U.S. defense, aerospace and defense. So again, and then obviously reiterating our long calls on Japan. So we've got 4 different exposures there on the Japanese side, and that just is it was a great buying opportunity yesterday, where we had and today really, but SCJ is kind of just sitting right there. That's the small caps, EWJ as well. But you did see a bit of a lower low in the Nikkei as of this morning, so that's just something to be mindful of. Doesn't necessarily mean anything, because we did see a higher high. So really, all that's really kind of telling you is that volatility's come back into that signal, and that makes a lot of sense considering the Nikkei pulled back from pulled back from kind of those highs of that 33,500 range down to 32,760 here this evening. So, but again, just some volatility in that complex can kind of just cause a little bit of havoc, or certainly near-term pressure on the equities as well. So just keep that in mind. But certainly Japan and the U.S. most recently has been kind of new opportunities where we've been grossing up our position sizing. But going back to kind of the 3 components that I really kind of saw on the page this weekend, and you saw it again this morning in terms of BTC, in particular Bitcoin. I had that big run up last week going into the end of the week. Was that folks in Russia buying some Bitcoin for some protection? Who knows? Is it kind of a quarter end, month end rotation? I'm not sure either. All I know is that signal, although still bearish trend, did put in a big higher low this morning, although it was also a lower high. So really what that means is volatility is coming out of that complex. Does it mean it's going to transition back to bullish trend? Most likely not, but it's just an area in terms of if you're looking for things to short, Bitcoin might not be the best place to be hunting at the moment until we get some new confirmation that we're going to see lower lows and lower highs. So you want that combination along with the bearish trend in order to kind of pick that piece back up. But so that's Bitcoin, and coincidentally, again, don't know if it's correlated whatsoever. Chris Moore, I was speaking with him earlier this afternoon, and he had kind of a theory that maybe asset allocators have what they might have used to put 5% into kind of the hard assets in terms of gold itself. Perhaps it's rotated to sort of a 4-to-1, right? So 4% gold, 1% Bitcoin. Does that impact kind of the quarterly rebalances, the fund flows? Speaking of fund flows, that conversation between Keith McCullough and Mike Green today, which revolved around options, but also just basically the flow of capital and how that impacts the market, was absolutely spectacular. You can listen to that and watch that for free on the Hedgeye website. So just make sure you go do that. It was an unbelievable conversation and definitely worth your time. But yeah, so again, the weakness in gold here is not, I wouldn't say it's not weakening. It's still a bullish trend, but you got a lower high this morning, and you've seen Keith basically gross down his sizing in terms of both gold and silver. He was a seller of 100 basis points this morning, and he's basically been selling on green and has reduced that that GLD position from I think at one point it was the largest position behind FDRXX, to kind of right in the middle of the pack here, with SLV 5 from the bottom. So again, just from a signal strength standpoint, gold signal certainly doesn't. I said, well, maybe it's just weakened really a little bit. So would I still be grossing up at the bottom end of the risk range? Absolutely. That's what the full cycle investing would kind of have you do. But that low end of the risk range is down at 19.19. And again, when you see Keith either talk about or take sell down some of a position of something that's been a core asset on green days, that kind of gives you a signal inside of the signal. So he even mentioned it on the SLV sell. I believe that was yesterday, or it might have been today. But basically, commented that his signal is telling him that he'll have an opportunity to buy silver back lower. So again, these things are all interconnected. You really do. I need to be paying attention, even if you don't touch your portfolio daily. This is where the weekend work really comes into play, right? So if you're seeing higher lows and some lower lows in terms of whether it be the trend risk range from inside of our ETF Pro product set, or if you're just kind of looking at it yourself and working through your own signal, the gold in particular is putting in. It didn't close the week down there, but last week it did have closing a new 1 month and 3 month low. So that's again, those are not necessarily components where you want to be necessarily buying the dip there. And as I just mentioned, Keith's been a seller of any up days, most recently in the last few days. The other component too is when you overlay kind of the risk range from gold in particular, and you look at kind of I see X2s out there. He and I talked about the euro last week, and what we would kind of need to see to get a bit more bullish on the euro. Interestingly enough, the next day, Keith switched that signal to neutral because it's confirmed on Monday that it's bullish trade, but bearish trend. But again, in terms of going back to the gold position, that top end of the risk range is really sitting right around the most recent 1 month high. That was from what was that? That was from June 1st, and that closing high is 1995.5. So with the top end of the risk range at 1994, you're really kind of just inside of that number right now. So you really want to see that top end of the risk range going higher, right? So that's where I have continued to reiterate the sort of tracking of higher lows and higher highs on both a day over day and week over week basis. When you see that immediate term risk range kind of not giving you the potential probability of creating a new 1 month high, or certainly or ideally a combination of both a 1 month and 3 month high, then that kind of tells you that signal isn't quite giving you the juice you might need to be confirming continuation in that bullish trend formation. So just wanted to kind of reiterate those 2 points. Don't know if that GC and BTC are correlated whatsoever, but certainly as of late, the US dollar and gold correlations have increased. So we're sitting at a plus 0.45 correlation on the 15-day. The dollar switched to a neutral trend this morning. So again, is this dollar weakness possibly impacting kind of gold in some fashion? Not sure, but that's certainly something to be cognizant of because we've gone from basically negative correlation. At one point, it was basically trending on negative 0.9 plus, like a greater than negative 0.9 for on multi durations, all the way going from 120 days to 15 days in terms of the US dollar versus the gold correlation component. So the fact that that's flipped and US dollar has also turned neutral, with putting in a big lower low there at 101.55 as of this morning, and a big lower high at 103.71. That's kind of should be telling you a little bit of something as well. So those are two of the big things or three of the kind of big components there in terms of dollar, gold, and Bitcoin. And again, kind of the same component in terms of the gold upper end of the risk range for the dollar. That's now sitting well within the most recent 3 month and 1 month highs, which we put in coincidentally, I think right around the same time frame, May 31st it was. was that closing high, and that one was up at 104.229. So we're kind of well inside that window. Now that those look back, and we've talked about the look backs a lot. That's going to take probably another week or so to kind of those higher prices in there, because that dollar kind of dropped. What was that? That was on June 8th, on the Thursday, June 8th. Had a bit of a down day there, down about 76 basis points. And yeah, so that look back window that's sitting at the kind of 10-day, that day's within the 15-day window, excuse me. So on a 21-day basis, it's going to drop out now and kind of over the next week. So again, could that signal kind of pick up steam if it sort of holds up in here around 102.53? Not sure, but that's certainly something that I'll be tracking over the coming next couple weeks, just to see how that U.S. dollar signal, in conjunction with the other strengthening of the euro or weakening of the euro. It's also gone, as I said, what has gone to neutral here in the last week, and keeps kind of signaling higher lows and higher highs. Now it's not. It's not back up at. Let me see. I think last week I said we need to get up to like one spot one, above 1.10, and that's kind of what it's done, right? So that top end of the risk range is at 1.103 this morning. So again, that's certainly telling you that the euro is certainly picking up near term trade bullishness, right? So as I mentioned, it was bullish trade, but bearish trend. And I don't know where that trend line is, but certainly something to be cognizant of and be prepared to sort of bob and weave, pivot, right? OODA loops within the FX market. So that was kind of the rundown. I see obviously some friendly faces if we want to kind of get a bit more of a back and forth here. As I said, this kind of moved it to the 8:30 slot, the late show. These do get, you can't tell, my voice is a little raspy. I'm a little tired today, but it's kind of why I moved them to 4:30s, because I just find them a little bit more, maybe a little bit more engaged or what have you, right, mentally. But that's okay. We'll just power through it, baby. But yeah, if anybody wants to step up, we can chat about anything in particular. I see Muni guys out there. I think he had a Twitter Spaces earlier today reviewing some fixed income and Muni bonds. So I'm sure he's got the replay available if you are interested in listening to that. Brian's always got some great wisdom out there on Muni space. I think John Kamprath as well, who I see out there too. Great insight from a family office standpoint. I believe the two of them hosted that Muni and fixed income spaces session. So congrats, boys. Good job putting that on. I haven't had a chance to listen to it, so apologies, but we'll be doing tomorrow, most likely on the train ride home. But yeah, let's get this party rocking and rolling. That's not a beer. That's just a spindrift, just FYI. But I'm sure that sounded like a beer. All right, well, as guys kind of figure out if you want to jump up or not, I guess I can keep rolling through the deck here, or not really a deck, but sort of rolling through my thoughts. The U.S. equities sector, we put on the green, red-eye, green-eye app, was buzzing green. That buy signal came out yesterday morning, so that was fun to see. Boy, was that fortuitous timing, and really, just a great signal by Keith. And we right ahead of basically at near the lows yesterday, and with that kind of greater than 1% move today in the SPX, definitely the right call. Does the U.S. equity market still have room to run? That top side is up at 44.33, so definitely has potential. So again, that's something where you saw a higher low but a higher high as of this morning, and really that's just kind of a narrowing of the range because volatility is coming out of the SPX. So again, this is something where, all right, we got some requests. Good, pokey. So with SPX, as these guys jump up, so that's a narrowing kind of risk range because volatility is coming out. But that top end is would be a new 1 month and 1 month and 3 month highs. So that S&P, even though it put in a higher low this morning, most likely that top end of the risk range is going to move higher, maybe a little bit higher because of pricing. Although in Keith's refresh risk range today in the afternoon, it was kind of relatively unchanged in terms of what the risk range looked like. And again, that could be very likely possibility just because of where the VIX is sitting at 13.73. It's down about 3.5% today. But again, my point here is, you got to watch kind of how the risk ranges are moving. So if we get any volatility kind of back into the market, sometimes that volatility can be positive. So we had components, I guess that was about a week ago to maybe 2 weeks ago, where you had a number of VIX up with SPX up. So will we get that same dynamic? Not sure. Mike Green and Keith talked about that component and the influence there of both VIX and SPX in their discussion on their webcast today. So again, I'd really highly recommend you go watch that. I think the one big commentary from Mike that I took away, and something that we've been talking on here a lot about in terms of shifting of focus, or certainly incorporating not just the VIX but also VIX 9D and VIX 1D. Now I put a bit more kind of weight on the 90 component versus 1D. 1D is just kind of like more of a good to know in terms of like what's happening in regards to volatility space today. But the Mike Green had a slide in there in his presentation where he was tracking the volume on both 30 days and I believe it was 1 or 2 day contracts. So basically, call them 0 DTEs, and the amount of volume, or the lack of volume, I guess, on the longer dated option contracts was quite astonishing. And so again, I'd really recommend you go watch that clip, watch that webcast. But yeah, John, Pokey, welcome.
Bob, can you hear me?
I can, sir. How's the West Coast?
It's another beautiful day in Tahoe.
Love it.
I'll see you in Vegas, if not before.
Oh, perfect.
But, anyway, hey, Fed question for some of the more educated Fed watchers than myself. Now that the TGA's being replenished,
yep,
and MT says they can't afford to let short-term rates go up much more because they have to finance all that debt,
mm-hmm.
right? And DDB on another podcast said she didn't think Powell would raise the next go round. But my question, and this is what I need some help with, with the QT, I know it kind of got masked with the TGA, but how much and how soon is going to just roll off when these things come to maturity? And what is the opinion on, are they actually going to start selling more securities instead of just letting them roll off? Because there's so much between fiscal and monetary funny money and stimulus out there. I think you're seeing that, which was what Green was talking about today. It's all flows. People are trading off the flows, which I've traded off of for quite a while. But could anybody help me understand what and if how much actual QT is going to be evolving in the next, say, quarter or so? And I'll mute up here.
No, it's a good question. If anybody's got any kind of more intimate knowledge on how kind of the TGA works, or sort of this concept, please, by all means, jump up and speak. I only know so much on a relatively high level, John, to be perfectly frank and open and transparent with you. But I've been reading a little bit on how they're kind of replenishing the TGA, but still, but really almost still providing some QE, right? So not quite the QT that everybody was anticipating. In terms of the things rolling off, I'm not sure.
And you'll notice that he gets very flippant or nearly brushes aside or tries to any question about real QT when he's asked about it, except for saying that they're going to let things roll off at maturity.
Right, exactly. And so, I go back to like the signal, John, because that's really, to me, that's, I think there's a lot of kind of opinions out there. And again, love Danielle, but she's, that's just another opinion, right? Like the signal in the data right now has the 2-year top end of the risk range at 4.81, and we're trading at 4.755. So yeah, there's like 5 basis points there, or sorry, 6 basically, in terms of to the upside. But until that starts to really move higher, John, to me, I'm in kind of Danielle's camp. So like it's Danielle, basically higher for longer, but how much higher? And right now the market is telling you that we're kind of basically things are relatively priced in. So that's kind of like, again, I'm trying to like dumb down the question or anything like that, but that's where the leaning on the signal really kind of just helps streamline, and you kind of don't have to necessarily like think as much, right, in terms of what does this TGA really mean? Is there more liquidity, less liquidity out there? Because you're going to get a corresponding one as well in terms of SPX. Whether you look at the S&P, the Nasdaq, the Russell, you're going to get, if there's quantitative tightening happening, you're going to see those signals start to pick up steam to the downside, right? So, Nasdaq's bullish trend, it's putting in higher lows and higher highs. S&P is still bearish trend, but it also, as I mentioned, is put in higher high and higher low today, and we actually went, put it back on the board for a trade yesterday. So that'd be my answer, buddy. I just don't. I don't think I'm in the camp. I'm also in the camp that I don't think this TGA is as diabolical of a situation as many kind of thought it might be over the last sort of couple months.
Yeah, because that's over with. Now they're replenishing.
Well, that's what I'm saying. Yeah, like the replenishment. I think they can kind of, again, they got a lot of things up their sleeve to John in terms of, how they can finagle the numbers, or not really finagle the numbers, but you get the point, right? Like they just have, they don't want things to necessarily crash. They don't necessarily want the party to be completely over. But they will do a lot of, they have a lot of like levers, I guess is a better way of saying it. There are a lot of different levers that they can pull. Kind of like how, if you think about the crude, the oil reserves, right? And how we were depleting those or kind of, putting those out into the market. And a lot of folks were anticipating that was going to have to get, filled right back up, and that was going to drive the price of oil back up. Well, it didn't, right? And they're still kind of in the process of filling those reserves back up. So, could there a similar situation happen with TGA? I got no clue. So, again, that's kind of why I lean on the signal.
Hi, I'm Keith McCullough, and I wanted to introduce you to my favorite product at Hedgeye, the Macro Show. Why is it my favorite product? Well, it's my show. I do that every morning. If you want to get ready for the market day, you want to contextualize all the data, you want to make good decisions, then this is what you should be watching. It's a repeatable process that you can deliberately study, measuring and mapping time series to time series of data. So it's not going headline to headline and getting whipped around. It's actually being so much more dispassionate about it and making good decisions that are data driven. So we'd love to have you on our team. Come join us.
Tune in weekdays at 9 a.m. Eastern and on demand anytime. Go to hedgeye.com/research to subscribe.
Ben, you jumped up. I don't know if you had any additional commentary around like the TGA and stuff like that, but by all means, happy to hear your thoughts.
Not first of all, long-time listener, first-time caller.
Yeah, congratulations.
I love the.
Thanks for jumping on.
I love the weekly notebook reviews and all that kind of stuff. My partner's a long-time Hedgeye user. I'm just kind of an intern. But on the TGA, that is an extraordinarily complicated topic. The first person I recommend everyone to go kind of read on that specific topic, especially when it comes to the actual plumbing side of that, is Conks, which is Concoda or Concodanomics, something like that. But they do these amazing kind of visual write-ups, very heavy on like the plumbing side of how it works between the TGA, the RRP, the Fed Reserves, all that kind of stuff. As it actually works in reality. When we were talking about QT, I'm in that camp of like, I'll believe it when I see it, because they've been talking about that since roughly this time last year. And they have never met their actual QT, projections. And I don't think that it was anything but a Freudian slip when, or Freudian, I don't know if I'm saying that word right, when Powell said skip at the last meeting, which implies that there would be a rate hike in June. I think that because their preferred metric is the core PCE, and that has been accelerating for 3 months. Because like headlines down for sure, but core is accelerating, and between that and a very tight labor market, when the Fed's goal is to frankly crash, not crash, but to very much damper the economy, I think that we're gonna get, short of a huge drawdown in core PCE and a decent rise in unemployment between now and the next Fed meeting, I think that we'll get a rate hike in July. And I think that especially labor is something that they're really focused on, and something I've wrote about a lot. It's been my pinned tweet, I think, for over a year now. But a quick note on the labor market, just because I got to throw this out there because I don't think I've talked to a lot of you guys much. The BLS is admitted themselves that they basically have no fundamental framework for measuring gig work. And a third of our labor economy in this country participates in the gig economy. 60 million American workers participate in the gig economy. And the BLS themselves have admitted that they don't actually have a comprehensive way to tabulate gig workers. And that was something that just didn't exist in the previous, economic cycle, the previous business cycle. So it's, these days it's easier than ever to sign up for part-time work, to, go do DoorDash, Uber, Lyft, Instacart, whatever you want to do. And that will skew employment numbers, and I think, in my opinion, a pretty substantial way. And again, the BLS is flying blind on this because they themselves admit that they don't really know how to calculate it. They don't have a way to calculate it. So I think that's really ultimately what's going to kind of keep the Fed's foot on the gas, is a really tight labor market that's kind of propped up by bad stats because of the gig economy. That's all.
Yeah, Mike Green's hey guys. Mike Green's talked about that on a couple of his podcasts with the issues around the birth-death model, with gig contractors needing to essentially, once they hit a certain number, I believe it's $10,000, that they have to go out and essentially start a business. So there are some really big structural issues around that. That's a great point.
I'm not going to pat myself on the back too hard, but I talked to Mike Green about that probably about 8 months ago.
So hey,
that's awesome, Ben. He was he was in the office today. It was great to see Mike. He's such a great guy.
I love that guy.
Yeah. Go ahead, Pokey. Yeah, really good insight, Ben. Thanks for that, buddy.
Yeah, I just cracked a beer. I don't know if anyone heard it, but Robert, you should have a beer. Robert, hey, I had enough beers
yesterday on the golf course.
Hey, man, have a great vacation next week. You've earned it. You do a great job, and thanks for. I feel like I'm the only one who's asked for this, but thanks for pushing it back.
I love you, but if it was only you, I might not have pushed it back to 8:30. But there's been a number of requests, so we'll try to rotate these in every once in a while. As I said, it's just to get some. Anyway, it just gets to be a bit of a long day. I used to have to do them at 8:30 because I had a real job, right? So I was doing other stuff. Now this is my job, so I can kind of do them when I want. But yeah, you still
have a real job, and you do great work with it, and we're all grateful for you, man. So hey, and at some point, you should put a plug in for what was discussed on that call today between Mike and Keith, because it's pretty exciting stuff. But and congrats to you guys for that. That's awesome. I've been looking through. I've been going through and looking at volume statistics, and so right now, just total volume market. I'm pulling it from CBOE. I have about 500 and just under 600 days of data loaded in so far. It's really, there's some interesting stuff when you start to dig through it. Like, for example, 5 of the top 27 volume days out of the last 600 are Fridays in June. and they're MOPEX Fridays. They're not end of the month. So it's, when especially dovetailing on what they were talking today with like fund flows and inflows and pass flows, it's going to be really interesting, I think, over the next few weeks to see what the institutional side is going to do. With a clean break on Friday, Monday is going to be dead, Tuesday's off, it's going to be, I think we're setting up really for a really interesting July. And just for today, I mean, I think everyone would pretty much agree, like today was a pretty broad strength day on the market. But I track, and it's an arbitrary number, I tracked about 262 stocks in my model. Out of the 262, and they're mostly names that over the years I picked up from Hedgeye. So they cross sectors, they cross market caps. Only 43 of the 262, which is 16%, were up on accelerating volume today compared to their trade duration average. So it's really interesting when you kind of take that next level, as Keith's been talking about, with where the money's flowing and what's happening. This is not as we're in something. I don't know what we're in, but there's not a ton of volume in a lot of places right now. Let's put it that way.
Yeah, that's a good point. Ben, I'll come to you in just one second, buddy. But yeah, good comment, Pokey. And that's, SPX, I think, had about 96% of its volume. I track it on a 5-day, so the 5-day average volume. I could plug it into 15-day, but yeah, good comment. And it'll be interesting to see kind of what that data looks like in the morning from the morning stat pack that we get, that Richie sends over, to see what his volume was on kind of like that day over day, 1 month, 3 month. I thought yesterday's. So again, like just to go both to not play both sides, but to comment on both sides of the coin here. That down volume yesterday was down 36% on a day over day basis, down 18% on a 1 month basis on that down move. So it's kind of, I don't think it's going to be quite that bad today. So again, I think really good comment. The volume's just been weaker. I think in general, if you've been tracking it or writing it down, the volume in the last few months is, on a 1 year basis. If you go out, track that number. I mean, yesterday it's down, minus 26%. If I flip to, basically, what's this? This is May 25th, same thing, minus 26% on a 1 year basis. So, has a quarter of like basically natural flows been pulled from the market? Are they sitting in money market accounts across the board? I'm not sure, but really good comment on the volume. I thought today's was the one that stood out to me in terms of like weaker volume was the Russell. So like IWM was up today on only like 83% of the average volume on a 5-day basis. So that to me was interesting, considering like SPY, both Qs were basically around, I think like 90, like kind of in the 90s, 93 on the SPY, and I want to say it was 98. Oh, I forgot the third Q.
Yeah. Nope. Yeah. No, you're totally right. On the 15-day IWM was 75% today, and on the 15-day SPY was 87. Okay. So when Keith says that, I'll give him credit when he says that the IWM is a lot weaker than the SPY. Like the numbers are, when you really forget just the price action, look at action. Yeah. There's a lot of validity there.
Yeah, 100%. And that Russell again, I mean, that's a really good comment. And the top end of that risk range on the Russell is 1861, and those recent highs up in that kind of 1900 range. Sort of I think that was like on June 15th time frame. Yeah, not quite, June 13th. That was the high. It closed at 1896. And so I mean, like the top end of the risk range is nowhere close to that at this point in time. So the weakness there is definitely very significant on the Russell versus things like the NASDAQ and SPX on the U.S. side of things, U.S. equities. Ben, let me come back to you, bud.
Just a question for don't know how to say his name.
Pokey.
Pokey.
You can call him Jason. You can call him Jason, though. I personally just I met him in real life in Hedgeye Live, and I still called him Pokey.
All good. So on the volume thing, so how much of that do you think is contributed to just the Russell rebalancing? Because it's obviously, the Russell 1, 2, and 3K only rebalances once a year. in June, right around that MOPEX. So how much of it do you think is that versus some sort of actual market action?
I without looking at the numbers, and I don't have that in front of me right now, so I don't want to speak, and I don't know. But what I would say is that, especially after listening to Mike and Keith today, people are chasing the things that are working, and a lot of the shit in the IWM, things want to go. I mean, like GameStop got a bid today. Like, things are trying to move, but are they really going to keep moving? And do people really want those things on their books too at the end of the month, at the end of the quarter? Those are the questions that I would have. I think that if things have had a nice move, I wouldn't be surprised if people are lightening up this week.
Yeah, I mean, Ben, to answer your question, sorry. Again, I'm not trying to be a dick, but does it really matter? Right? Like, the volume is the volume. So the flows are the flows type thing, at least in my view, right? So and that's where the signal will pick it up. That's why it's price, volume, and volatility. So if you do get an increase in volume into, say, the Russell, you're going to start to see that. And you're going to see the signal pick it up, and you're going to see that in the price action as well. So it will be interesting. I mean, I think, if you do get a rotation, let's just say, we're going into, on paper, we're looking at a quad one in Q3. Q3 starts next week. So is there potential for some form of rotation? Now, again, this is where the signal will drive the decision making in terms of like where we, what piece of inventory we put on the books. But you could make a case again in a quad one environment that you could get maybe some rotation to smaller caps, higher beta, momentum names. But I mean, we've also kind of have seen that in the last month or so. I mean, the closing lows on a 1 month in the last 21 days wasn't that long ago. It was only a month ago, May 31st at 1749.65. So in the last month, in the last 21 trading days, that things moved basically 150 points. So it's had a big move off of what had been kind of a trading range there from March to April of kind of call it 1720 to 1800.
So what kind of perked my ears just on the volume comment was, I know that June, I believe at least for the SPX, historically, as far as historical average returns on a monthly basis, I believe June is either the second or third worst month of the year.
Yeah, July's one of the best.
So was June the? Do you know if June is June the second worst month of the year next to September?
I don't remember off the top of my head. I just know it's on the bottom. Basically,
yeah,
bottom quartile.
it's a crappy month, but that also kind of made me wonder too, just because obviously typically volume precedes price and yada yada. So that just also was part of my thinking on that.
Yeah, good comment. Pokey, I know you've been working on your model a lot. Any other kind of interesting components jumping out at you? Love that you're doing some volume analysis.
It's individual stock things, like a couple tickers, but I know that's not really what we do here. What I do want to bring up, and I don't know if anyone has any opinions on this, I think that the Supreme Court ruling on student loan debt is going to play a big factor in where the market goes from here. With Paul talking that decision could come down any day, you would expect them to try to get that done before the 4th of July. Get that out. I don't think that they're going to want to have it hanging over their heads and they just clear the docket. I think that that's going to be a huge factor in determining, especially with retail names and a lot of the small caps. But that's going to be I think that's going to tell a lot with market sentiment, with how people are going to start position and what the signal is going to sniff out over the next few weeks. And that's going to carry on for the rest of the year.
Yeah, I'm nodding my head. I think, until that comes out, again, it's sort of one of these things where kind of like the TGA, kind of like the oil reserves, will they find a way? I don't know, right?
Yeah, I mean, I have no idea, and it doesn't matter. And I know it doesn't.
Yeah.
Whatever they do, it doesn't matter. My student loan debts are fucking private, so I'm screwed either way, right? But I'm still on the hook for $319.33 a month. But like I think it's going to be really interesting to see how that factors in, because that's a big linchpin and that's a big unknown. And when you talk about, especially with people that have student loan debt, with the high inflation numbers and everything, like that could be a huge consumer, spending boom or bust.
Well, that to me, so I think that piece of the puzzle, Pokey, almost plays out in 2024, right? So like that's going to be, Keith made that comment, I believe it was on the Macro Show this morning, where it might have been with Mike Green, I kind of forget, but he made a comment, and we've talked about it here on Week Notebook Review because it's in the numbers, it's in the data, but in terms of the growth expectations moving forward, right? In terms of basically somewhere between this quarter, we're still predicting a negative kind of Q over Q GDP number, but then basically sort of somewhere between 0 and 1, right? So like 100 basis points in terms of like Q over Q growth. So relatively flat. And if you look at, so my point is that if those numbers or if like the student loan debt does come back on, I think that's going to start to impact. That'll have more of a negative impact on say earnings and also just general GDP growth in the kind of basically call it Q4 quarter of like earnings. So that won't get reported till 2024, right? And so on and so forth. So kind of like that prolongation of, how long could we be in this sort of like kind of they call it this like, rut, right? Like kind of, in terms of, maybe it's growth. That's why I say quad one, although it's a quad one on paper, it is only like very nominal sequential growth. So, how much of an impact is that on kind of earnings and, the quote unquote euphoria of the market? I'm not sure. But it's a really good point. And I think, it's something to be cognizant of. So many eyeballs are on that though, Pokey. I mean, like it's mentioned on like every other, again, this is not a dig on you, buddy. I just like, it's mentioned consistently across like spaces, like
totally
everywhere. So, how, I just don't know. I don't know. I think if they punt it, that's going to have a bigger impact than if
what do you mean by punt it?
Like if they could kind of figure out some way of like having this either prolong the like when they return or
it
somehow...
would be the 9th time that they extended it.
Right. I understand. I'm just saying, guys, like, if they somehow figure out or like do something to basically push it back further or to get there, if this, if somehow the Supreme Court doesn't, rules in the favor of, basically the administration and, then, what happens then? I don't know. It's an interesting component. And the other one too,
it's fast.
In terms of like, because you mentioned Paul Glincher, I think this Activision, I mean, that merger arb is incredibly attractive. Now, I'll just leave it at that. I know we don't really talk stocks here, but that merger arb, I think if Paul's right, that thing, I mean, it looked even better last week. But yeah, still got, what is it? Still has a think I want to say like, what's that? The deal's at 94, right? So it's got about $10 left, or is it at 87? Deal's
at 94,
right? Yeah, so still got about $10.
Hi, Robert McGroarty here, Director of Subscriber Development at Hedgeye. Hope you're enjoying our podcast. Start generating alpha with our suite of Sector Pro investing research products. Dive deep into retail, industrials, technology, and everything in between with exclusive access to the sharpest analysts and actionable ideas on Wall Street. Go to hedgeye.com/research to subscribe. Enjoy the rest of this episode.
Paul's been on a roll. Paul's he's always great, but I think the past 3 months with the stuff he's put out that he's talked about on the morning call has been huge. And I think it's really telling though, the fact that he says this could go either way, because usually he's got he's probably got a pretty good pulse on it. So for him, if it's a toss up, that's I think that's the and like I said before, it's
on the student loan side. Yeah.
Yes, I'm sorry. I went back to that. Yeah. And I don't, whatever it is, whatever happens. And it's I just think it's one of those, when you're looking at, what are catalysts, like that is going to be a catalyst one way or the other. And it's, the media the blind squirrel finds a nut every once in a while. So I got a question for you. I know you're tired. I don't want to pepper you, but so knowing that
my brain's back and firing.
knowing that
I think I made the mistake of, rather than sitting at my desk, when I was having my salad at dinner, I turned on Disney Plus. I watched that the first episode of the Nick Fury new show that's out, and I think that was a mistake, Bokey. I need to go back. I needed to be at my desk eating my salad, still drilling down things. I kind of did all the work ahead of time, and so I think that was my mistake. I'll learn for that. I'll remember that next time. It's been a minute since I've done 8:30 Spaces. I should know better. You just got to fucking keep grinding through it all. Stay sharp. Now I'm back in it. Now I'm like driving.
All right. So now that you're back in it, okay. Now the tough question. So knowing that Hedgeye is forecasting, knowing that you guys are forecasting like a shallow quad one starting in a few days, how are you personally approaching that? And what are your thoughts around adjustments that you're making to your portfolio, or are you just in a wait and see mode right now? Because the line between shallow quad one and shallow quad four is really thin the last time I saw it, and the last time I heard Steiner talk about it.
Yeah, let me just pull up. I got the updated deck. Yes, or it's like should be in with Lord Macro Pro, I think today. Okay, Dragos. 1 second. So we're still on QRQ
because you were. Yeah, the reason I'm asking is you were a power user. I don't mean to talk over you, but I'm going to talk over you. You were for those of you who don't know who are relatively new to the call. Robert was a huge power user beforehand. So the reason I'm asking now is now that he's inside and kind of seeing how some of the sauce is made, I'm curious to see how his thinking has changed.
Yeah, so it hasn't really changed much because really the signal kind of drives a lot of what I would. The signal drives like all of my portfolio allocation, right? So, and you've seen that signal kind of confirm itself, and some may say it was late to the party, whatever, but it is what it is. I mean, the signal is the signal, and you've now seen kind of confirmation in terms of, say, the NASDAQ. XLK has been on the board for quite some time now. A number of the larger cap, high quality names, the Elite Eight, as we've kind of dubbed them here on the weekly notebook review. Many other than all but Tesla and Amazon have gone back to bullish trend over the course of the last few weeks. In terms of the data, in terms of quad one, the signal. How I've approached this quad one as soon as I saw it on the page was that it was going to be signal dependent, right? In terms of like what was going to be working is going to be all driven off the signal, because it's exactly to your point in terms of it's basically been a coin flip between quad one and quad four. So just for folks listening at home who might not have this data, and it's going to get reiterated and provided again by Keith for the Q3 macro themes presentation on Thursday. But the conditional probability of quad one in Q3 is 46.3%, and the conditional probability of quad four is 39.8%. The interesting component here is that the conditional probability of quad one in Q2 has gone from has increased basically to 41.9%, and conditional probability of quad four had been sitting up at kind of like 64, 65%, and now it's down to 55.6. So you basically have almost kind of, except it's the reverse right now on the board. It's sort of quad four, a little bit more of a fair fight there in Q3, but you basically have this kind of conditional probability saying kind of quad ones, quad fours in both this quarter and next quarter. So I think again that's just where the signal will help drive where you position your portfolio, and then the quad four in Q4 is sitting at the conditional probability is 57.4%, and then you basically kind of have a quad three at 17.3% and the quad one at 19.4%. So really kind of like a bit of a coin flip in terms of like what's second place there in Q4, but you again, depending on how the data starts rolling in, that Q4 number could also shift, and that's kind of what I've been tracking more closely. Pokey is sort of what's the rate of change or the conditional probability on the page in the book, like on the deck, right? So like as data has flowed in, and we keep getting that economic data, then how have those numbers been shifting? And I think that in conjunction with sort of, tracking the signals quite closely in terms of what's putting in higher highs, higher lows. Again, even if they're in bearish trends, things can be bullish trade and still be in a bearish trend, and we saw that in, say, the Nasdaq, or we're seeing that in the euro last week, or still this week, where it's now neutral, but it's bullish trade, bearish trend component. So it depends on how you position your portfolio. If you can play it a little bit more nimbly in shorter term, which I can, then I will play more on that kind of trade duration with the desire and the goal to basically invest in the full cycle, right? So you're kind of playing that trend. Like I ideally put on a position and don't touch it for, say, weeks, right? Like in the perfect world. Now that doesn't necessarily always happen, and I incrementally touch stuff all the time. But yeah, that's kind of, again, that was a bit of a long-winded answer, but I think that's sort of how I'm thinking about it. And even this Q2 number is going to be interesting as we continue to get data rolling in, and I've
Thank you, man. Thanks for sharing.
Yeah.
Go to Palmer. Go to Palmer.
Yeah. What's up, AI? Does that say AI Palmer?
What's going on, McGordy?
I'm good, man. How are you?
I'm all right. Long time no talk, man. Been busy with life. Hey, just a couple thoughts on some of the things I've heard. One, just a brief note on the student loan forgiveness thing. In the budget deal, they basically prevented any, potential executive action, from stopping that. So if the Supreme Court does what I think they'll do and stop it and make people go back to repaying, that gigantic screaming sound will be all the retailers in the economy going, oh shit, what's coming? I just don't see, I just don't see, but it's Washington. They could always figure something stupid out down the road, but I just don't see how that doesn't have at least a 1 quarter or even potentially a 2 quarter impact on spending. And anecdotally, I noticed this. We were on vacation in June, but it does still seem to be that vacation is somewhat strong. But we were down to Orlando, and I was kind of surprised at how we went to Universal, and it was not that crowded for that time of year. And you'd think it'd been more crowded than that. So I don't know. I kind of wonder. I think people are still kind of slowing down on their spending, but it makes you think that it's kind of this whole, YOLO type. I'm going to, get in what I can while I can do it. And, once reality starts to set in, I just don't see how the economy holds up, because especially when you look at the last couple consumer debt numbers that were reported, because they were just atrocious. And it's clear what people are doing. I mean, if they're basically propping the economy up on their credit card. The other thing, I was curious, you said something, and maybe I missed some big news, but they've not put one drop of oil back in that reserve as far as I'm aware. Am I missing something?
No, that's my point.
Well, maybe I missed your point. Maybe you're not the only one that's tired.
No, my point was that basically when many folks anticipated that they were going to have to replenish the oil reserves, and therefore it was going to put like a floor under the price and or drive it higher, because they were going to be in the market, right? And from a supply demand situation, and they have not they've not done that. And so is it possible that they kind of do a similar situation with the TGA? I don't know. But that's kind of, again, they have to it's just a very complicated issue, and one that I am no expert on, and I think many on Twitter, or neither are many on Twitter. So Ben, I'm going to have you repeat. I tried to Google it. Did you say it was CONC? Conc? Or I don't know if you can still speak. You're on mute.
What's that?
The papers that you, or the organization that you said, what was it that I was trying to Google it on the TGA? I wanted to read up on it. You said it was like Conk or something?
I posted in the Nest. It's
perfect, man.
Yeah,
it's brilliant. Conks.
Yeah,
got it. Okay.
Yeah,
Cool. Brilliant. Thank you very much.
Also, just on travel really quick, if you're trying to track that, the only thing that you should be watching, and this is a wonderful resource if you're not aware of it, the TSA publishes daily checkpoint numbers for the entire nation in the U.S. And you can just go right to their website, and they publish this data going way back when. That's a huge thing I watch, because we're waiting to kind of see travel numbers break in a meaningful way to short specifically Airbnb. Fun fact, the largest number of age demographic guests for Airbnb is also the largest age demographic of student loan debt holders. I'm just gonna say that, and do with that what you want. I hear someone giggling.
That's me. That's McGroarty. That's great. Leo, welcome to the show. Or Pokey, sorry, go ahead.
No, I'll go to Leo.
All right. Leo, you're on mute though, mate. Maybe you can't talk. All right. Hey, Leo, when you're ready, you unmute yourself. Pokey, I'll come back to you.
Yeah, I'll filibuster.
Right.
No, I totally. The overlap between Airbnb and credit card debt and a lot of other things is fascinating. Ben's spot on there. Anecdotally, and purely anecdotal, I live in DC, but my current foster dog's getting adopted in Charleston the weekend after July 4th. So I was looking to see if I could find an Airbnb that wasn't like $2,000, $3,000 a night, somewhere between DC and Charleston. And there are a shit ton of places that are still open on Airbnb and Vrbo for next week. And it's astonishing that the number of places that are still there, and also the number of places that still want extraordinary amount of money for the rent. You're going to see, I know DDB has been talking about this. You guys at Hedgeye have been talking about it with this. That's what's going to really change up the commercial real estate in a lot of these, especially the coastal and the vacation places. You're just seeing right now, the ones that are selling, you're seeing boomers just come in and pay cash for the places. But if you go to the real estate listings, you see they list rental income in the real estate listings for a lot of these places.
Yeah. Go ahead.
I don't remember what it was. DDB posted something last night. I saw on Twitter a chart that looked at one of the real estate markets about being a relationship between listings and Airbnb properties, and that I'm in new home construction. That's one of the more, of course, it won't affect our market. I'm in Kansas City, so it's not a very strong Airbnb rental market, but it will be interesting to see what that does to housing prices, and if that does end up becoming a big problem, because in some of these bigger cities where there's a significant amount of those, there's no way that doesn't impact the supply. But to what extent, who knows? Because supply sucks so bad right now it's not even funny.
Yeah, I saw a tweet earlier about it, so I just posted in the Nest. Actually, it was about kind of the Airbnb revenue. Well, they called it collapse. I haven't gone that deep onto the. I really just looked at the chart, to be perfectly frank with you, but I did post it in there. I planned on reading the thread later, but two of the places that they were highlighting was basically Phoenix and Austin, Texas, in terms of basically 46-47% drops in revenue from May year over year for the month of May. So definitely, the impact on the housing. Again, I mean, Palmer, you know this better than anyone, and certainly one of the potential reasons is that ITB or kind of the housing stocks themselves have been quite strong is due to the supply demand situation that's out there. And so could this be some of the supply that these Airbnb owners do they need to, if they're not getting the revenue to cover the mortgage payments, do they need to basically put those houses onto the market, and is that the supply that's going to be that's going to impact the pricing that's relatively stayed sticky and high for longer in most places across the country.
And, add into that too, what's the thing that most perplexes me and I find fascinating is what's going to happen if we get a break in interest rates. It's been surprisingly strong. I mean, it's not like we're setting any land records here. I mean, we're down like 50% year over year in terms of revenue, and house sales are down quite a bit, but interest rates sky high, and they're still looking, and they're still buying. And it's like I keep telling people that the most fundamental thing to look at in whatever we get into the serious side of this recession in the housing sector will be, people will definitely buy houses if they have jobs, and so that's the big question: how bad are job losses? When we finally get into the shit, and that'll be the destiny of the housing sector. If job losses aren't that bad, especially in some of the markets that are a little less desirable, you're going to see a real. There's not one housing market in the United States of America. There's a bunch of micro markets, and there'll be some areas where I don't really think it's going to hurt them that bad. I think we're actually one of those markets because the cost of living is super low here, so I don't think it'll drag us down that much. But there'll be some places where it will. So
yeah,
it's going to be interesting to see how this is not equally distributed.
Yeah, John, thanks. So Kemperth tagged me and shared the DDB tweet, Palmer, that I think you were mentioning. So it's up in the nest as well, just in terms of Airbnb rentals versus homes for sale. So yes, that's really good stuff. Thanks, John. Appreciate it. Ben, back to you.
Hi. I reposted that article like 3 or 4 days ago. I went through the entire data set, and it is fucking alarming. If I can curse here.
You certainly can. Yeah.
I'm already like 4 beers in, so it's,
I like it.
But so yeah, I went through that entire article, and because they referenced all the data, and I went through it all, and so. Quick background: in my ex-life, I was in construction and construction administration and management out here in Las Vegas, Nevada, going into and up to the GFC. So I got to see, because like we were just like building entire subdivisions with like 2% take rates. Like I was there to witness that sort of insanity, and. To the credit of the builders, they are not doing that this time around. They're trying to really cater to what they think will be like the most kind of profitable geographies and like the most sustainable geographies. Like they're not just kind of like piling into every single bubble the way that they were during the GFC. Because again, like I was on the front lines for that. That was, basically destroyed that ex-life of mine when I was there. But it gave me a lot of really good experience, looking back, obviously. So there's Phoenix is fucked with a capital F. I don't know why anybody thought it was a good idea to like build up all these tracks in a city where like your average summer temperature is 110 degrees Fahrenheit. That is just insane to me. They had the stadium build up. That was a really short-term thing. But in my humble opinion, we are in an Airbnb bubble right now. And if you don't think that, I would encourage you to go on Facebook, and you can join any number of Airbnb owner groups. And like that's one of my favorite sort of like anecdotal, temperature taking things to do. And there are a lot of people that have leveraged themselves very heavily to buy multiple properties, obviously mortgaged against, leveraged against their existing properties. They do like the old school, multifamily slumlord sort of leverage model. But that is a very real thing, in my opinion, that's going on right now, is that you're getting all this leverage within the Airbnb kind of network effect, framework, business model, whatever you want to call it, where everyone thinks they're going to be the next fucking real estate mogul. by renting out Airbnbs at any cost. Because again, like these people are buying blind at these current interest rates. God bless them. And it's very different from the GFC because obviously it's not the banks that are levered. It's the actual, weirdly, it's the consumer side that is really holding the cards. But again, just go on to like the Airbnb owners groups. Everyone thinks they're like the next Warren Buffett. They have no idea what a cap rate is if you ask them. It'll open your eyes to a lot of things. But that's the big thing. And something that just very recently came onto my radar, because I did not think this was a problem until very recently. But if you go to, I can't remember the website, but there's a few different researchers out there. But there's the homes under construction in the U.S. right now is higher than the GFC, even when you adjust for a population, like a per capita population increase. We have more homes under construction right now than during the GFC, even with the population per capita, like the per capita population increase. That to me is completely insane. It tells me that there's a lot of like leverage and speculation out there. It's not the same thing as the GFC. Obviously, it's like the banking sector is going to collapse, but there is a lot of leverage out there. Like, just again, I'll find that and put it in the nest. Give me a minute.
Cool. One thing I'll caution you with on that national statistic on homes and productions, be careful. Sometimes that, I don't know which figure you're citing, but the most commonly cited number actually includes lot production, which are not actually an actual production home. So there are sometimes what they include in that statistic is the potential for a production home. So that could be a developed piece of property, but they're not actually entitled to actual home builders yet. So that's one thing to be careful with that.
I'm right there with you, but no, this is under construction by a builder. Like it's permits versus under construction versus a third category. I can't remember, but I'm going to put it in the nest in like 2 seconds.
Cool. Check it out when I get it up.
Thanks, Ben. What else? Leo said he's on a bike, so he actually just accidentally hit the request to speak. I'm not really sure how you do that, Leo, but I love you, buddy. Good job. It must be really intense bike workout that you're on right now. Or maybe you're on a motorcycle. That'd be even cooler, actually, in Michigan. But pretty sure you're working out. Palmer, what else? What's on your page? How happy were you when Keith added uranium to the ETF Pro list last week?
That's always a little gift to my heart.
I know how much you love I know how much you love URA, and then he went even further. It is interesting. He went even further, and he added NLR today too. Oh
man, I missed that. That's the utility.
Yeah, he's doubling up on the uranium ETFs.
Well, it was interesting. There was some news yesterday that was it just goes to something I've been saying for the longest time, but. Norway, they've had this stupid, we're going to be, zero emissions by 2040. And they're like, well, shit, that ain't working. So they decided that if we're really going to, meet these zero emission goals, that they're just going to go full bore into nuclear. So, it's just a matter of time for, some of these people to figure it out. But what I found most interesting, I didn't know this had happened, and I don't even know how you play it, but, China actually put the first ever thorium reactor into production. I think it was this month or last. I read Jacob Shapiro. He's a geopolitical analyst. He's got a great free Saturday morning note called Global Sitrep, and he mentioned it in there. I think it was last week. But the thorium side of the uranium thesis, that's a problem for uranium, because if that ever gets rolling, I mean it'll definitely change things. And for those that don't understand the difference, thorium is a unique reactor design that they use molten salt to keep them cool, and the risk of a meltdown is basically none. They're super clean and really kind of the future of nuclear. I didn't realize it was that far advanced, though, but it was kind of interesting to see that China was doing that.
Hi, Robert McGroarty here, Director of Subscriber Development at Hedgeye. Join our entire research analyst team live before the market opens for deep dive investing analysis, our favorite stock ideas, and our risk manager in chief, Keith McCullough's macro overlay. Our team of 40 plus equity analysts discuss key market developments, trends, and our high conviction long and short investing ideas. You will not get this granular level of insight anywhere else. A video replay, audio version, and analyst summary notes from the call are available shortly after each live show to ensure you don't miss anything. Go to hedgeye.com/research to subscribe. And tune in live to the call weekdays at 7:45 a.m. Eastern. Enjoy the rest of this episode.
Yeah, I didn't see that, but that's cool.
Thorium is definitely the future. I did share the data point for the homes under construction. Awesome. That website also, again, you can go in there. It's Mortgage News Daily. They can break it out by permits. It's permits, under construction, and again, a third thing I can't remember. It does it by region, everything else. And again, population adjusted, under construction, we're over the GFC right now, which I just didn't realize until recently, which made me feel really dumb. But it's, in my opinion, definitely worth paying attention to.
Interesting. Cool. Thanks, man. Appreciate it. First time caller, you're really putting out a lot of value there, buddy. Appreciate it.
I'm trying.
I love it.
Full disclaimer: I work on cars for a living still. I'm just a dumb guy, but I love. I mean, I've never not been fascinated with capital markets since 2012. So here I am.
That's awesome, man. No, congrats. That's good.
I've tried to work on a car before. It made me feel pretty fucking dumb, so I wouldn't say
that. Car, yeah. I feel pretty. Yes, agreed. One of our good friends in our town. I was driving by his house the other day, and he had his wheels off. He was putting on new brakes, and I stopped the car and I said, "Mike, I'm impressed." So, I mean, I'm pretty handy, but I don't know if I don't think I could put on new brakes on the car. I don't think my wife would trust us driving the car afterwards.
In my opinion, always leave safety critical systems to professionals.
Yeah, exactly right. Yeah. All right. So one thing we haven't really talked about is on the commodities. I mean, that was kind of my segue into URA there, but Palmer, he didn't really pick up the ball and run with it, so that's okay. I'll keep rolling. I think on the commodity side of things, the ag space I think has been kind of interesting. Jay Van Sciver talked about or alluded to kind of the droughts and the impact and sort of how those really don't necessarily impact kind of agriculture on a longer term basis, or certainly the kind of supply demand situation. So perhaps it is just a sort of head fake or counter trend move, but certainly, in terms of weekend work, I mean, if you pull up the chart of corn or soybeans, you can just see the move that they've had in the last, not only last month, but sort of month and a half-ish, basically from their lows. They went from basically, the craziest part is like corn in particular went from a high in the last 3 months of 677 down to a low of 554, and now and then back up to kind of a high of 670 as of Wednesday, June 21st. But that signal, I mean, basically, they've given a lot of that back in terms of corn and the corn space in terms of the futures, right? So ZC is what I was looking at there. But DBA definitely is kind of picking up some decent sort of trade duration on at least on my screen that I'm seeing here. So just want to kind of call that out for the group. Copper did put in a higher low and a higher high as of this morning. Interestingly enough, that higher high where it's at 3.95. So that would be a 1 month closing high, because that high was same thing that last June 21st. That high was at 3.9135. So just keep an eye on that. I think, again, not the bigger component there, and that's been bearish trend for quite some time. The low is 3.70. So again, that would not be so that would be the top end and low end would basically be a higher low there in terms of where we're coming from most recently. So that 1 month low is down at on copper down around that 3.637. So again, just kind of keep track of that, and not saying it's anything in particular, but just sort of from just the commodity space in general is sort of, even oil. Keith called it out this morning in terms of putting in a big higher low there on oil down at 67.14. So is it something that we should be kind of thinking about, as Pokey, you were asking about the quad outlook and, how things are potentially looking down the road? Could we get sort of a bit of a quad 3 dynamic rather than quad 4 in Q4? Let's kind of like see how things play out. We're certainly still got a quad 3 on the board in Q1.
Hey, Robert, I thought, I haven't had a chance to look, but I thought oil was in contango out in the third quarter. Is that still accurate?
Oil?
Yeah.
In Q3?
Yeah.
Well, we got quad 1 on the board in Q3, so that commodities.
Yeah, no. What I'm saying though is what I'm saying is if oil is in contango, it's forecasting not exactly a good environment for oil. So just something to keep on in mind as you're thinking about the quad outlook and everything.
Yeah, no, exactly. Yeah, but you can't also deny like the higher low most recently, and even as Keith said on the macro show, could this be just a kind of a very near term component to where, and then we'll get price action to the downside? Not sure, but I think it's just worth calling out where a lot of these commodity complex and even from an inflation side, we're still forecasting basically inflation out to I think it was like 3 in the threes, right? So we got a 415 basis point year-over-year CPI projection for the U.S. in Q2, and that going down to basically the low threes, 3.31 in Q1 of 24, which is like a slight ramp higher from Q4 estimates of 3.20, so 320 basis points. Listen, my point of bringing that up, Palmer, is just I think just keeping a keen watch on the commodity complex. Commodities still absolutely underperform in quad 4 environments. I think the signals so far has been really good, especially on the oil side of things. Today was really the first day where we saw kind of that higher low, and that was off of the back of kind of 3 or 4 down moves, right, over the last week. So I think it's just like an interesting component there, but nothing's really changing. You're right in terms of the trend, and even on a trade, still very much bearish trade and trend. Just something to be kind of cognizant about. Good stuff. All right, well, that's kind of all I want to say on the commodity side. Oh, natty gas. Natty gas looks like a beauty. That's going back to bullish trend. Just FYI, I know that's a squirrel. I like to call natty gas the Medusa, because it's like dancing with a beauty that can also turn you to stone.
Real men and women trade boil.
Oh yeah, baby. Natty gas. I've stopped messing with boil. I just do, but I do play. I do like UNG call options right now. Yeah, go ahead, Ben.
Oh, so sorry, I'm just an asshole generalist. In my opinion, oil will be the trade, because as every oil well goes down in productive volume, it outputs more natural gas. That's just the name of the game. Like, that's just how this stuff works. Yeah. So, and like we have so much stranded natural gas just in the USA, let alone everywhere else in the world. But just in the U.S., we have so much stranded natural gas assets that they just flare off for to the tune of millions of BTUs. It's like, do you want to bet on the byproduct. It's like silver. The way I kind of separate it, it's like gold versus silver. Gold, we have a finite known amount of it. And then like silver is a byproduct of a lot of other stuff. It's, I'm born and raised in Nevada. It's, we're the silver state.
Yeah, you are.
So, this was, the whole kind of genesis of that is that there was all this blue shit coming out of the ground. Everyone's like, oh, we don't want that. We want the gold. And all of a sudden everyone realized it was actually something that was worth something. And it was basically a free resource at that point. So they mined it. Which was very short-lived because, again, it's a waste byproduct. Same thing with natural gas. Natural gas is the silver to the oil that is gold. And as time goes on, especially in the Permian, wells will just get gassier and gassier, and oil will become the gold, and natural gas will become more and more the silver, especially because it's such a stranded asset. It's very difficult to pipe out, to build the infrastructure for it. And like in 3 to 4 months, when Europe is inevitably going through another climate crisis, that could be a great time to like play Dutch or like a Dutch arbitrage. But for now, like I still think oil is the play because it's just structural underinvestment, yada yada yada. You should know that. You guys know this kind of stuff. But that's just my take on it. Because again, like natural gas, like it's like we're flaring it off as fast as we can in so many different fields. Like it's not worth anything. Because again, it's this. There's so much of it compared to oil.
Yeah, I see Tim's out there. I don't know. Tim works in the space. I don't know if he's able to jump on or whatnot. But yeah, I mean, listen, I hear you, Ben. All I know is that the signal says bullish trend on the page, and but with that said, the downside is to 2.26, and that would be the trend line that we got last week was around 2.61. So we're currently above that. The top end of the risk range is only at 2. There's only it's 2.97. So you've got about 17 cents to the upside, and about 55ish to the downside. So so 54, I guess it is. So yeah, go ahead, Palmer.
So buy some coal.
Huh?
I say go buy some coal then.
Maybe, I don't know. But I mean, I'm just, it's been a good trade. 90 gas. Anyway, Tim's up. Timbo.
Hey, Robert, I got to run. Thanks for having us.
Cheers, Palmer. Yeah.
Appreciate it.
Thanks, buddy.
Take care, brother.
Timbo, how you doing, bud?
I'm good. Robert, how you doing?
I'm great, man. Whenever folks talk oil and natty gas, I think about Tim Bozeman.
I appreciate that, man. Sorry, we're actually at the beach on vacation. Just
nice,
the first
buddy.
part of the conversation. I just caught the last couple of seconds. What's the?
Oh no, just I was just commenting on natty gas is bullish trend, and our new friend Ben, he was commenting how basically oil is more so the longer trade with nat gas, so much of natural gas being flared off, and just like that's a byproduct of really trying to find oil. And you've commented similarly about such on here before, but just wanted to kind of get your take.
Everybody calls nat gas a squirrel, and it's because it's, to Ben's point, it is hard to store natural gas the same way it's easy to store oil. But that being said, everything's going to whip around here for a long, long time, and there's a lot of opposing forces. If we get Cheniere back online and we get our LNG export capacity up, could that be bullish for Natty? Yeah, that could be bullish. If we keep getting crazy hot summers, is that bullish for Natty? Yeah. Are there a half a dozen operators in the Haynesville that can go frack a bunch of wells and turn on, a BCF a day in about 3 weeks? Yeah, that's also true. So there's a lot of opposing forces there, and so I'm not really playing in the natty space because there's such short-term supply-demand, chop in that. I just haven't played in it.
Fair enough.
The oil space is a little bit clearer to me. His comment on the Permian is true. It looks like the Permian guys are running out of inventory. But you got to remember the shale oil is light oil, and what we really need a lot of to make diesel and heavy things is heavy oil. So that trend remains unbroken. If you really wanted to run out there next time oil gets close to breaking trend and short a bunch of shitco's who are running out of inventory, that'd be a great idea. The one thing I've got my eye on is the services side, which those poor boys can't catch a break. Services are pretty much fungible. All the frac pumps can move around the country wherever the work is. All the wireline trucks can move around the country wherever the work is. And what we've seen is, people are laying down frac crews. People are laying down drilling rigs in response to the current oil price and the current natural gas price. There's a lot of people that have drilled wells that aren't completing them on the natural gas side, waiting for that price to come up, and that's going to provide a lid on pricing at some point in the near term. That could all change in 6 months. So I've been playing, shorting stuff like KLX, shorting stuff like OIH is the index ticker for the oilfield services. When it pops to the top of the range, just go whack it on the head and ride it down and cover it. It's been a great little recycle trade.
And there you got it, folks. As simple as that.
Dude, you guys want a trend follow or a trend trade? Look at Halliburton. I refer to this as Halle Berry because I have all these pet names for these tickers I know really well. But HAL, look at Halliburton. Every single time it dips under 30, look what happens to it. That is, if that's not a trend, then I don't know what a trend is.
If you want to play in that space, it's like most really highly operationally leveraged businesses, that are highly indebted, and it takes a lot of capex to continue their operations. You just go and look for the ones that are the worst off on operating leverage, and when prices break trend, go grab them.
That's awesome. Well, I appreciate you jumping on, Tim, especially while you're on some vacation. You said you're down at the beach?
Yeah, we're on the 3-week RV extravaganza. We made it all the way up from Fort Worth to Niagara, and right now we're on the beach in South Carolina, and we're going to go to the U.S. Space and Rocket Center and then back home.
Nice, man. Well, we'll keep enjoying that fun ride. I'm sure you're having a great time with the family, so appreciate you jumping on. And
appreciate it. Thanks for having me, Robert.
Yeah, buddy. We've been pushing an hour and a half here, guys, so I think we may just wrap up. That was a great insight, Tim. I'm kind of natty gas and oil complex. You too, Ben. Appreciate it. Thanks for first time caller, or long time listener, first time caller. Appreciate it, Ben. You did a great job up here tonight. So to all those, if you didn't get a chance to hear me say this at the beginning, there will be no notebook review next week. I'm on a little bit of holiday with the boys, going on a golf trip up to Wisconsin, playing Sand Valley. Should be a lot of fun. And then but we'll be back at it the following week. So again, thanks for everybody for tuning in. We got macro themes here on Q3 macro themes from the macro team and Keith on Thursday. So tune into that from a Hedgeye side of things. And then if you didn't get a chance to listen to Mike Green and Keith this morning, that was a phenomenal webcast, and they made the announcement that we are partnering with Tier 1 Alpha. So Hedgeye's made an investment into that business. So we'll have some more options, data and option and all that kind of stuff. So kind of going to finalize the product, all that kind of thing. But look forward to working more closely with Tier 1 Alpha. But with that, everybody, have a great evening, and good luck trading out the rest of this week. All the best. Talk soon.
Don't forget to check out Hedgeye.com to get more actionable investing insights from our team of more than 40 research analysts. And check us out on Twitter at our handle, @Hedgeye. This presentation is informational only. None of the information contained herein constitutes an offer to sell or a solicitation of an offer to buy any security or investment vehicle, nor does it constitute investment recommendation or legal, tax, accounting, or investment advice by Hedgeye or any of its employees, officers, agents, or guests. This information is presented without regard for individual investment preferences or risk parameters and is general, non-tailored, non-specific information. This content is based on information from sources believed to be reliable. Hedgeye is not responsible for errors, inaccuracies, or omissions of information. The opinions and conclusions contained in this report are those of the individual expressing those opinions and conclusions and are intended solely for the use of Hedgeye subscribers and the authorized recipients of the content. All investments entail a certain degree of risk, and financial instrument prices can fluctuate based on several factors, including those not considered in the preparation of the content. Consult your financial professional before investing. The information contained herein is protected by United States and foreign copyright laws and is intended solely for the use of its authorized recipient. Access must be provided directly by Hedgeye. Redistribution or republication is strictly prohibited. For more detail, please refer to the terms of service at hedgeye.com/terms of service.